CVS has hit a new low for the year. You'll see 52 weeks all the way back. It has never been this low. $71.65 today. And we are reporting earnings tomorrow. So will it bounce from here? That is the question. Today is May 2nd and earnings is tomorrow, May 3rd, before the market. And so in this video, we will take a look at those unusual options and analyze them and then show you what our earnings trades are for this earnings on CVS. So let's get right to it. For the unusual option activity today, there weren't so many, but the one that we most significantly saw was these 300 contracts. This is for the expiration of May 5, done at 9:44. This was the 75 strike calls and the 74 strike puts. Keep in mind, this is not as much. The buying power required was, you'll see here, they sold the 74 strike puts, so therefore this required 7,400 capital to put on. And since there was 300 of them, this was about $2.2 million of capital. And so when we look at this trade on May 5, you'll see here, the 74 is right here. The also calls are over here. We know that the calls are possibly open, but we're not sure because the volume here is 1,600. There's an open interest of 1,000 of them. So since it was 300 contracts, it could have been a closing order. So rather than assuming that they had sold the 74 and buying that 74, if you were assuming that they were open contracts, you may think it is very bullish because this is a bullish synthetic trade. However, this could be also a closing order. And so we are not as bullish as the charts suggest that perhaps there is a bottom. We are actually instead more concerned about another option that were placed a few days ago. That was done on the June 16s here. These unusual options were in the 4,000s, you'll see here. This was June 16. This was 50 strike calls and puts. You'll also see these 4,000 at the open interest here. For this kind of a position, they had bought the 50 strike puts and sold the 50 strike calls. And this is a synthetic short. And so this trade required a lot more buying power to put on. And so, and this one definitely was an opening order because when we were monitoring this, these were open orders. You'll see here, we were watching this a few days ago and saw this. So we don't always have the time to make videos for every single unusual options that we're seeing. Maybe if we had more resources, we could do that. But at this time, we don't. And so, but we can tell you that this was a very bearish position on CVS. So based on this unusual options activity that we saw a few days ago, we actually are bearish on CVS instead of that potential synthetic bullish call spread here that you see here, and also these 80 strike calls here that could imply that it is a bullish trade and perhaps it has bottomed and it will go up after earnings. But we are more bearish than bullish. However, we will hedge it. And so this is what we did for our trade. For the 75 strike calls here, we bought this one. You'll see here our position. You'll see the extrinsic value 1.4, and also here it is, lots of open interest too. we have the 75 strikes, and we want to make sure when we do this trade, we are going to not have a excess of extrinsic value. 1.4 is the one we bought, so let's try to sell something that can give us more extrinsic value back, or at least break even. So here we are, another 1.4 here. So that is why we decided to sell the 72 strikes. That way we're not really paying anything extra for the options, because extrinsic value is the actual cost of options. And so this is our trade. It's a bearish diagonal trade. And so you'll see here that as the price goes down in price from the 72, we will be profitable. And if the price stays where it is, we will also be profitable, because here we are. The blue line is the profit line at expiration. Zero is, as long as it's above zero, it is profitable, because we have a very high theta for this trade. And so it does not have to move at all, and it will be profitable. Our break even is also extended all the way to 74.88, you see here at expiration. So it can actually rally all the way to 74.8 and still be not a loss. So even though it's bearish, it is still has its hedges in place. And what we also did besides this is we had added an additional hedge in case this after earnings, because earnings, anything can happen. And since we are at a low for the 52 weeks all the way back, and we've never been this low, there could be a lot of potential buyers to buy the dip or to buy the lows here, and it could rally. So what we did was we bought a very cheap call to hedge that and for our bearish trade. And so what we did was we bought the 77 strike calls. They are at the delta of 15, so close to 16 delta, which is that one standard deviation of probability of happening to go into the money. So we bought this 77 strike as our hedge for our bearish trade. And then you'll see here when we put the two together, this is what our trade looks like. If it does increase, you'll see that in price, you'll see that the purple line does not really go below this zero for a loss, because we have that hedge in place. Only if we waited another day after expirations, because tomorrow is May 3rd, then we may start seeing some losses as it starts to dip down in this area here is the loss. So by that time, we would have already taken off this trade. So we would, tomorrow when it's May 3rd, there won't be much of a loss if it does rally, right? Because that purple line, which represents May 3rd, is never below that zero on the upside. It's only the blue line, but the blue line is the expiration date, which is the May 6th. So we won't let this trade go on for that many days or the end of this week. We're going to take it off tomorrow and also reduce our risk for the FOMC that is going to be coming up tomorrow as well. So this is our earnings trade. It is has a high probability of profit. Call that POP, probability of profit. So you'll see here is our positive theta trade, which balances out that positive vega trade. We need a high theta. If we do a earnings trade that is positive vega, we want to have a very high theta to balance that out, because we know vega will actually hurt the trade. So we need a theta to counteract that vega crush that happens after earnings. So as long as we have a good theta, we won't be having that negative Vega crush on us. So this is the trade, and we are seeing, and if it does drop, we'll then be able to keep our trade, our bearish trade on, and continue to stay bearish on CVS. And so then we will continue to monitor that 4,000 contracts that we saw here. As we mentioned, this trade is based on this June 16, these 4,000 contracts here that we had detected being placed, very bearish. And so we will monitor this. Once this is, if this is closed, then we will be less bearish. So so make sure to subscribe and hit that bell icon, and we can notify everyone when we see this being closed. Then this is quite significant and meaningful to our current bearish position. Okay, so that is our plan for the earnings for CVS that will be reporting tomorrow morning. And hope you learned something. Please smash that like button and subscribe if you haven't. Hit the bell icon. You'll be notified when we see unusual option. Take care, everybody, and good luck.